Greetings and good morning, everyone. This is Dave Yeski, and I'm very happy that you could join us for our current webinar, Groundhog Day. Before I proceed, I just want to handle a few housekeeping items. I am able to see messages if you enter any questions you may have during the presentation. I'll try and get to them, and if I don't, we will, of course, follow up afterwards. Secondly, I wanted you all to know that Elisa Bowie is on the line but muted. However, those of you who know Elisa know that she might pop in at any moment, especially to render a little levity.
Well, just so you know, I've maintained control over my own mute button.
Allow me to just proceed. This is a quote that some of you may recall from Liz Ann Saunders' webinar that we produced. She had a version of this quote, and I think it's really quite relevant now. The real essence of it for me is that we tend to be ruled by what has just happened to us. You know, we tend to put more weight on the past than may be justified, on the immediate past. And I have to say that based on many conversations with people, hold on one moment, please. Sorry about that. Based on many conversations with clients and others, it seems to me that, frankly, a lot of people are still traumatized by the events of late 2008 and early 2009, and of course the continuing events. I don't want to minimize the fact that although the recession was officially declared at an end in June of last year, the reality is that unemployment rate remains at a very high level, persistently so, and that has created a lot of ongoing suffering for people in this country and around the world. Nonetheless, there can be an excess of pessimism. We can be led down that path that says that, you know, it's different this time. This time is so much worse than anything we've ever seen before that all of a sudden anything we believed before it has to be thrown out the window, and we have to start with a clean slate. And of course, there's nothing in the world that can scarier than a clean slate. So today what we're going to spend a few minutes talking about is the degree to which that may be true, the degree to which the world may be different than it was before, and the degree to which it may be the same. So the fundamental realities that we see around us, the fundamental reality is that we don't really know what's going to happen next. Nobody does. But the real problem is that we keep convincing ourselves that we do. That's actually the source of the greatest source of pain and the greatest potential danger is when we convince ourselves we can anticipate what's going to happen next. We can make some kind of a short-term prediction and act accordingly. Some of you have read the works of Nassim Taleb. He wrote a couple of very interesting books, one called Fooled by Randomness, and the other called The Black Swan, which The Black Swan ended up being the much more famous book, and in fact the phrase the Black Swan has sort of entered the general lexicon, and you see it almost everywhere now. His concept of the Black Swan was his name for an event that is completely outside of our assumptions, completely unanticipated. In fact, it specifically comes from the European history when no one had seen anything in all of the centuries and millennia of European history. No one had ever seen anything but a white swan. And so there was an assumption that there were only white swans could exist. And then in Australia, in the 20th century or late 19th century, they discovered black swans. And suddenly assumptions went out the window. It's, however, what happens after. It's what happens after the black swan occurs, the event that's completely outside of our assumptions occurs, that we get ourselves into trouble. Because as Taleb points out, after the totally unanticipated event occurs, well, we explain it to ourselves. And in explaining it to ourselves, we convince ourselves that we understand it, that in fact we can anticipate it again, that it wasn't such an unusual event after all. And so what we do is by explaining to ourselves why that unanticipated event was inevitable, we give ourselves a greater sense of our ability to predict. And so this then becomes our danger point, because we under-anticipate extreme events. And one of the things that he does, actually, he has a doctorate and he is a professor, but he also runs a hedge fund of sorts. And their strategy is to bet exclusively on extreme events. Because of the fact that he believes that human beings tend to discount extreme events. They tend to have excessive faith in their ability to anticipate extreme events. They underprice them. And so his investment fund goes out there and it buys options and futures on extreme events. Essentially, they're making bets on extreme events. Well, extreme events don't happen very often, but when they do happen, they pay off in a disproportionately large way. And so he has the kind of investment fund that makes no money for long stretches of time, and then hopefully makes huge sums of money, and then goes back to making no money for long stretches of time. But coming back to this notion of how we explain things to ourselves and then believe they're inevitable, one only has to think back to the late 1990s and the tech stock bubble, which was popped in the year 2000 and, of course, continued to deflate in 2001. And you would have thought that would have somehow prepared us for the next one, but it didn't. We had the real estate bubble. Somehow the inevitability of tech stocks going up forever, even when that illusion was popped, it didn't prevent us from shifting our attention to the next illusion, which was that real estate prices could go up forever. So here's an example of the limits of prediction, and I should laugh. You can't really see much here, I know, but each of these little boxes represents a different country, and each of these little boxes represents let me get a pointer going here, and let's see here, I think I'll just use my normal arrow. Each of these columns is a year, 1985 through the end of last year, 2009. And each of these is a country, so the top country, and this represents the returns in the given year. So in 1985, the top country right here was Australia. The next year, the country that had the highest returns was Spain, and so on. So next year it was Japan, and so on and so forth. What's interesting about this is that it's very rare for countries to repeat. Now, there was a 3-year stretch in the early 90s, 91, 92, and 93, when Hong Kong had the top returns 3 years running. But that is the only instance you'll ever find of that. Otherwise, you can see that this colored pattern is very random. You can't predict which country is going to have the best returns in the coming year. It gets totally mixed up each and every time. And in fact, the U.S. was never in the top. The U.S. market was not in the top line at any point. So this shows that unless you have the most amazing crystal ball imaginable, you're really in no position at all to anticipate what's going to happen next year. So this scary asset class is really, really something. I mean, you could look at this and think, wow, that's pretty volatile. I wonder what this is. I will tell you that the long-run average was just shy of 10. And what we're looking at is annual rainfall for San Diego from 1850 to 2009. Now here's another chart, looks almost identical, slightly different time frame. The long-run average also about 10. S&P 500, 1926 to 2009, to the end of last year. You know, it's not an accident that these look similar. There is, in fact, a significant degree to which markets are like the weather. Many of you, I did an article a few years ago, which is on the website, and I've shared it several times, so many of you have seen this before. This image on the left is it's the Smart Money's map of the market, and it's an attempt to sort of, in colors, visually show what different industrial sectors are doing on any given day, with red being those that are having extreme losses, and green being those that have gains, and the brighter the green, the higher the gain. This on the right is actually a radar map of a major set of tornadoes and storms that pass through the Midwest. And I like to hold these up because I think in some ways they look similar, and for me that's a jumping off point to talk about why, in fact, the markets and weather are similar. And it's because they're both examples of complex, chaotic systems. This, in fact, is the fundamental reason why it's virtually impossible to predict the future in any detail, whether you're trying to predict the weather, or you're trying to predict the course of the economy, or you're trying to predict what's going to happen in the stock market. It's because of the complexity of the system. When you look at the weather we have on any given day is it's the sum of all of the interactions of the uncounted trillions of molecules in the air and the land and the sea, and we can't actually observe those in real time. So we know we understand how the average interactions play out, but in detail we can't say where they are. And the same thing happens with the economy, and for that matter with the markets. At any given point in time, the markets represent uncounted billions of interactions between millions of investors who are all showing up with their non-overlapping bits of information, and they're embedding that in securities prices through their buying and selling. Likewise, the interaction of individuals in market economies through their buying and selling activities also decide how those economies are going to run, how resources are going to be allocated within those. But the key is that complex, chaotic systems are not utterly free of patterns. There is some order that emerges, some long-term order. It's like if we look at this particular graph of rainfall in San Diego from 1850 through 2009, well, we can see that there's a lot of randoms from year to year, huge variations in rainfall. You know, we have 27 inches one year, and we have 6 inches the next year. I mean, that's a pretty amazing swing. But there is a regularity. You notice that there is not a trend upward or downward, that all of these ups and downs tend to cluster around just under 10 inches. And so in any given year, if someone asks you, what's the rainfall next year going to be in San Diego, you'd say, I don't know. It's going to be something probably around 5 inches to 30 inches. People wouldn't necessarily think that's a very useful answer when they're planning for whether or not they should repair their roof. However, your best guess is probably going to be to say, well, it's going to be just under 10 inches. Now, in the next year, the chances are that it's not going to be just under 10 inches. The chances are it's going to be above that or below that. However, with each succeeding year, the cumulative average is going to tend to converge on that 10 inches. That's one of the regularities that emerges from this otherwise chaotic pattern. And so we have to look around and say, well, if the system, if the world economy, the U.S. economy is too complex and chaotic to make short-term prediction viable, and if the financial markets, which are embedded in the U.S. economy and the world economy, if they too are too complex and chaotic if they're so complex and chaotic, I should say, that they defy short-term prediction, what are the regularities we can look to? What are the regularities we can observe that might give us some faith that there is some basis on which to make our plans for the future, that there's some firm place to stand? So some of those are, frankly, around the ebb and flow of the business cycle. The business cycle just represents the expansion and shrinking of the economy. Certain regularities can be observed there that we can turn to and to some degree rely upon. Within the financial markets, there are certain regularities that also emerge, not every day and not every year, but over longer periods of time we tend to see them, and there are reasons why they continuously emerge, and we'll talk about that. Equity returns, which is to say the returns to stocks, tend to be higher, almost invariably are higher than those to risk-free investments like T-bills or even somewhat riskier bonds like intermediate and long-term bonds, value stocks tend to have higher returns than growth stocks. Small company stocks, likewise, tend to have higher returns than large company stocks. So here's an example of the ebb and flow of the economy. This shows the alternating bull and bear markets in the U.S. as based on the S&P 500. For the period January of 1926 all the way through September of this year. So this is through obviously 2 months ago or a month and a half ago. And what you can see, a couple of things, you can see that there is, first of all, sort of a regularly repeating cycle of advance and decline, advance and decline, advance and decline. So there's a regularity to this when you look at what is, approaching a century, 90-year period. This regularity recurs again and again and again. But, and this is where the complexity comes in, it doesn't recur in precisely identical fashion. Some periods of expansion are longer, some periods of contraction are shorter. Some periods of contraction are longer and expansion shorter. So that it's a regularly recurring cycle, but the details of the cycle are not precisely predictable. You couldn't build an investment strategy around what you observe on this. Well, let me put it this way. You couldn't build a market timing strategy based on what you see on this chart. Now, this is the same thing, but this is for the Morgan Stanley Capital International EAFE Index. Now, EAFE is an acronym for Europe, Australasia, and the Far East. And it's an index that attempts to capture the performance of blue chip stocks outside the U.S. And so what you can see is in these are developed markets. So we're talking about Australia and Japan and the United Kingdom and France and Germany and so forth. So in the developed markets outside the U.S., you see this recurring pattern of advance and decline, and it's predictable that there will be an oscillation between advance and decline. That's pretty well established. But the exact nature of it, how extensive the advance will be and how versus how extensive the decline will be, not precisely predictable. Varies very much. However, going back to regularities, let me point out that if you were to sum up the average advance against the average decline, what you would find is two things. You would find that the period of advance tends on average to be longer than the period of decline, and the magnitude of the advance likewise tends to be much greater than the decline. In fact, if you looked at the average duration, bull markets tend to last almost 3 years, whereas bear markets tend to persist for about a year. So we're talking about advances on average tend to be almost 3 times as long as periods of decline. Likewise, the magnitude of the advance, during the average advance, the market's up over 100%, almost 120%, whereas the average bear market decline is something more in the neighborhood of 30%. And this, again, this is a pattern that you see repeating in developed markets outside the U.S. In this case, the average decline is of almost exactly double the duration of the average, the average advance is double the duration of the average decline. So now let's look at equities. Stocks get priced in a certain way, and they get priced to have a return that compensates you for the uncertainty, the scariness that goes along with them. Now, the risk-free rate, the 1-month Treasury bill, which is, by all measures considered to be risk-free, is considered the least scary asset you could possibly have. Some people look at what the U.S. government is doing now and they worry about its fiscal status, but for all practical purposes, any Treasury security is going to be utterly free of default risk, at least in our lifetime, and I would suggest even well beyond that. What we see is that stocks, we believe that the markets price stocks to have a return in excess of the risk-free rate, because that's what investors require. And what we see in practice is that that's achieved. It doesn't mean that the risk-free investment doesn't sometimes dominate the risky investment. In fact, it's almost by definition that it has to. If the risky investment always did better than the risk-free investment, it wouldn't be risky. If you were guaranteed that every single year stocks would have a higher return than bonds or would have a higher return than T-bills, well, that's not risky. So the fact that it can underperform from time to time is what makes it risky, and it gets priced for that. But in being priced for that, it tends to outperform, on average, vastly more of the time. You can see here the statistic up here, 84% of the time since 1926, stocks have beat Treasury bills, T-bills, over 10-year holding periods. Here's another look at the same thing, only different holding periods. And again, you can see that for 20, 30, and 40-year holding periods, there's never been a holding period that long where T-bills beat stocks. There's only been 5% of the time, 5 times out of 100, that there was a 15-year period where that happened, and so on and so forth. In any given 1-year period, this comes back to the point I was making earlier, there's a 30% chance that T-bills will beat stocks in any single year. So that means 2/3 of the time stocks beat T-bills, 1/3 of the time T-bills beat stocks. But here's the catch. In that 2/3 of the time when stocks beat T-bills, it beats them by a massive amount, huge magnitude. In the years in which it beats T-bills, it's beating T-bills by a factor of 3 or 4 or 5 or 10 typically. So it doesn't have to beat them more often than 2/3 of the time in order to have vastly larger returns in the long run. So what's the other one we talked about? Value stocks versus large company stocks. Value stocks are those that are trading at some kind of a relatively low valuation compared to other stocks. In other words, if you find some financial measure by which you can rank stocks in terms of how relatively expensive they are, the values, whether it's some people use price to earnings ratio, some people use price to book ratio, some use dividend yield. You don't even have to know what those things are. Those are just ways of ranking stocks in terms of how expensive they are versus how cheap they are. The stocks that are priced cheaply have higher returns. And of course that's because when the market prices them cheaply, it's requiring them to have a higher return. So when you look at value stocks, you find that 98% of the time, let's just call that virtually all the time, they beat the rest of the market. They beat the rest of the large company stocks as a whole over any 40-year period. 90% of the time for 30-year periods, and on and on and on. Now, even in a given year, it's not a coin toss. In any given year, close to 60% of the time, value stocks will dominate growth stocks or the market as a whole. Now that's not all the time. And one might say, well, why don't you actually have some growth stocks in the portfolio, since they, 40% of the time growth stocks do better? Well, part of the reason for that, first of all, one gets growth stocks if you just have a broad market index like the S&P 500, which in any given year is a blend of both growth and value and sort of average valuation stocks. But growth stocks, when they do better than value stocks, they do better by a small margin. Again, it's because the markets are pricing value stocks for higher returns. Now, here's another look at those two with different holding periods. Value stocks versus growth. Now this is specifically value versus growth. So we're taking the two extremes of the market. The cheapest stocks at one end and the most expensive stocks at the other. Now we're really getting into it. And what you find there is that in any 25-year period since 1926, value stocks have beat growth stocks 100% of the time. In any 20-year period, again, value stocks have beat growth stocks 100% of the time. 15, might as well call it 100%. It's 99% of the time. In any 10-year period, 96%, and in any 5-year period, 86%. So even with holding periods as brief as 5 years, you can expect any value stocks or value stocks as a group. That's an important point. As a group, I'll talk more about that later. But as a group, value stocks will beat growth stocks even in holding periods as brief as 5 years. There have been a lot of 5-year holding periods since 1926. Now this is the other one I pointed out earlier, small stocks versus large stocks. In 25 and 20-year periods, we're talking about 83 to 96% of the time, small beat large. 15, 10, 5, you see it's still the majority. Even in periods as short as 5 years, small stocks beat large stocks 60% of the time, more than half the time. And this is with small stocks being known for having for having returns that tend to cluster. You know, the economists refer to the return pattern being involving temporal clustering, which just means that it tends to cluster in brief periods. So while you can say that in any given 15-year period, small stocks beat large stocks almost 80% of the time, but much of the time they may have beat large stocks in a 3-year period or a 4-year period. So you might have gone 6 or 7 years with small caps lagging, and then you have 2 or 3 years in which they blow the doors off and make up for it. This is also one of the reasons why one wouldn't want to build a portfolio exclusively around small company stocks, unless you're willing to kind of be in the wilderness, you might say, for 4 or 5 or 6 years at a time, waiting for that period of outperformance when it'll all make up for all of the underperformance. This is something we saw back in the tech stock boom, you know, the dot-com boom of the late 90s. From 95 through 99, that 5-year period, you had large company stocks, blue chip technology stocks, blasting small company stocks, you know, right out the door. Small company stocks here in the U.S., small company stocks overseas, significantly lagged those big blue chip stocks in general. They lagged especially the blue chip tech stocks, and that was half a decade. So for fully half a decade, small company stocks lagged. But in 2000, 2001, 2002, when the blue chips fell apart, it was the small caps that rescued portfolios. So you didn't want to have a portfolio that was entirely small caps. You would have been really unhappy during the latter half of the 90s. But you wanted to have some in there. You may even have wanted to have a significant number because that's what rescued your portfolio in the first few years of the 2000s. Well, the same thing applies around the world. This is the same thing looking again now at overseas markets outside the U.S. And you can see that actually in overseas markets, this value versus growth thing is even more extreme. For all practical purposes, for every holding period from 5 years on, value stocks beat growth virtually 100% of the time. 100% from 10 years on and 98% of the time for 5-year holding periods. I'm going to declare that to be indistinguishable from 100%. So value stocks beat growth stocks in overseas markets virtually all the time if you're looking at holding periods of at least 5 years. Same thing applies with small company versus large company. So this phenomenon of small versus large and value versus growth is not something that's unique to the U.S., even though it's been observed in the U.S. certainly for the better part of the 20th century and beyond. It's a phenomenon that is persistent in all financial markets around the world. And it's because markets are pricing them for that. Why do small company stocks consistently beat large? Because markets price them for that. Because they have a unique increment of return. And human beings, all other things being equal, don't like risk. And therefore, since the markets are just human beings, they price things in a way that takes into account the risk. And here's where we come. Why should we expect them to continue? Markets are just made up of human beings. Markets are social constructs. You know, we very often will find ourselves, you know, looking at pictures in a magazine or watching the news on TV, and the images that are used to convey what's going on in the stock market are all very mechanistic. You see charts, and you see statistics, and you see big monitors with numbers rolling across them, and it makes the market start to feel like a big machine at some point. But in reality, at its most fundamental, markets are just human beings coming together and trading with each other. And human beings, you know, except for the possible adrenaline junkies who like to jump out of airplanes and whatnot, human beings are generally risk averse, which is to say, all other things being equal, they don't take on risk unless they're given some sufficient inducement to do so. And so when human beings come together and they price these risky assets, they price them such that the expected return is going to be big enough to induce us to take on all that uncertainty. Think of all those choppy charts I showed you earlier, you know, where if you look at even the S&P 500, the so-called blue chip stocks, in any given year, you might have to anticipate a 40% loss against the possibility of a 50% gain. That's a pretty big range, and a range that big is, for most people, is pretty scary. So they get priced to have a higher return. And although the markets don't get it right every year because surprises show up, the world is unpredictable, remember, in the short run, they get it right on average over time. So this is why, so again, the notion that the aggregate behavior of large groups exhibits regularities is because human beings are fairly stable. Our psychology as individuals and our, you might say, social psychology, how we interact in groups, is fairly persistent. We are not radically different human beings. We're not wired differently than our parents, our grandparents, or our ancestors from 100 or 500 years ago. Our brains are wired quite the same. And when we come together in groups, we have certain norms that tend to recur. Again, it's not precise. You know, groups exhibit different behavior over time, but it tends to cluster around norms. And so when we come together as large groups and start to trade in markets or start to go about the business of living our lives and buying products and voting with our dollars, we tend to have certain common patterns that appear. You know, James Surowiecki, who writes the money page for The New Yorker, wrote a great book called The Wisdom of Crowds. And he looks at the wisdom of crowds in many different contexts. He certainly touches upon the economy and the financial markets, but he looks at many others. And he actually started the book with an interesting story from Victorian England when a statistician was at a country fair. And he found that someone was running a raffle. And in order to participate in the raffle, you had to guess the weight of this dressed hog. Big giant hog hanging in the shop, and I don't know what a hog weighs. I don't remember from the book, but a fully dressed hog has got to weigh 200 pounds or 300 pounds. And so people would guess. There was a big jar, and you would pay your penny or your pence, and you'd write your guess down along with your name, and you'd throw your slip of paper in the jar. And at the end of the day, the person running the raffle went through and read all of the slips, and the person whose guess was closest won the raffle. Well, what this statistician did is he managed to talk the guy out of the jar of guesses, and he went back and analyzed it. And what he found is that the average of all the guesses, of all those hundreds of guesses, was precise to within an ounce. Even though the best individual guess was off by whatever, a pound or two, the average of all the guesses was almost precisely correct. So this is what we see in markets and in economies, is that there's an emergent quality where when you aggregate everybody's non-overlapping bits of information, the sort of the consensus that emerges tends to be closer to reality than the single best guess. This is also, gets it all the way back to 1776. I know we all think of the Declaration of Independence here in the U.S., but it was also the year in which Adam Smith published The Wealth of Nations, one of the first and certainly most famous works of economics, even though I think Adam Smith considered it to be a work of philosophy as much as anything that we might consider economics today. And he talks about how individuals pursuing their own self-interest, when you aggregate all of those individual pursuits into large groups of people, we tend to have a superior outcome for everyone. Everyone is better off for the emergent quality from the interactions of individuals that are just pursuing their own individual interest. So when we think about these regularities, it's also a question of perspective. The time frame matters. Time frame matters. Regularities, things that don't look regular in one time frame look very regular in a different time frame. So when we think about, for example, again, coming back to the stock market, you know, even during a period where over sort of with a larger time frame or a larger perspective, the markets are advancing, in the short term, you're going to have volatility. And in fact, long-term returns are the sum of short-term volatility. Here's an example. I hope you can see this. So this is the S&P 500, and you can see it's a little jagged line. It's obviously got a positive slope to it over the years. Some interruptions along the way, but the general trend line is positive. This magnifying glass is grabbing just the year 1999. Now, the year 1999 was one in which the market was up over 21%. So for the year as a whole, the market was up over 21%. But on a monthly basis, the market actually declined 5 months out of 12. 5 months out of 12, almost 50% of the time on a monthly basis, the market was declining. And in one of those months that had a positive return, one of those months being April, had an almost 4% return, it was actually declining in 10 out of 21 trading days. Again, virtually 50% of the time, it was sinking over the course of a month in which it produced a very respectable return for a month, almost 4%. So your time frame will matter. Right, when you step back, you can see regularities when you step back and look at the horizon that you can't see when you're up close and personal. When you're looking at the daily newspaper, or you're turning on CNN or CNBC or any of the rest of the often sometimes, not always, sometimes financial pornography, you get hypnotized. You get hypnotized by the ups and downs, whether the ups and downs are day by day over the course of a month, or the ups and downs are month by month over the course of a year. But those ups and downs are just noise. They're just noise around a much larger trend, and the much larger trend is driven by economic fundamentals. And the economy as a whole is going to tend to advance more often than it declines. And not just because it has always done so. I mean, that would be a very simple argument to make, obviously. Well, it's always done so, so it's always going to do so in the future. I would suggest that it's because, again, the economy, the U.S. economy and the world economy are just made up of human beings. What we call economic activity, again, at the level of the economy as a whole, everything gets reported in statistics. The Bureau of Labor Statistics and other government agencies, they report every month the gross domestic product, and they report inventories, and they changes in inventories, and they report inflation rates. And again, on you see statistics, and the whole thing starts to feel like a big machine that's going on around me that I have to somehow adapt to. Well, the reality is that what we call the economy is just you and me and your friends and neighbors and everyone you know going about the business of living our lives, going about the business of earning money and spending money and saving and investing, and the aggregation of all of those individual actions adds up to what we call the economy. And to think that the economy is not going to be fundamentally biased towards growth and advancement is to suggest that human beings aren't fundamentally biased towards constantly adapting their activities in order to make themselves better off. And in the long run, human beings, in going about the business of adapting their activities to make themselves better off, tend to succeed more often than they fail. And that tendency towards success aggregates up to an economy that tends to grow more often than it shrinks. So let's bring up another question. This is one that's on a lot of people's minds. You know, again, if you're reading the newspapers, you've been seeing suggestions that economic growth going forward is going to be slower than it has been. By some measures, the recovery so far, the economic recovery, the stock market recovery has been pretty impressive in many ways. But the recovery in economic activity has been somewhat tepid compared to recoveries from prior downturns that were as sharp as the one we experienced. And so there's a lot of talk about slow economic growth. And this gets extended to talk about the magnitude of government deficits and looming problems with the soaring costs of Medicare and the Social Security obligations that the government has, and all of those implications for growth and the risk that it's going to lead to an extended period of slow growth. So naturally we address ourselves to the question of, so what does that imply for the market? You know, I mean, we certainly care about how fast the economy grows because we want an economy that's growing fast enough to shrink the unemployment rate, and we want an economy that's growing fast enough to ensure that our children and grandchildren will have jobs. But beyond that, we also, you know, intuitively assume that the rate of economic growth is probably going to be reflected in some way in the stock market. Well, and therefore, just to finish that thought, if the U.S. economy and perhaps even the world economy, outside of China, which of course you know, everyone knows is booming like mad, although if we had another hour, I could go through the economic reasons why China's rate of growth is not going to be sustainable in the long run. You can't do simple linear extrapolation of what China's doing or any other economy. In any case, these concerns about the potential for slow growth in the U.S. and for the evidence. Here you'll see is from the period 1971 through 2008. This is the period during which the good data is available. If you take if you separate out all of the developed markets, now I have another one for emerging markets. I chose not to put it on here. I'm focusing just on the developed markets. If you take all of the developed markets, all the developed economies, and you sort them between those that had a high growth rate and those that had low growth rate, and then you look at what the subsequent returns to their markets were after they got classified into high growth or low growth, what you find is that the high growth countries, they had an average return to their markets of just shy of 13%. Standard deviation, this is just a measure of how volatile they are. You know, if you think about some of those earlier charts that I showed that had all those lines flying up and down, well, the bigger the swings, the higher this number would be. So the average return of just shy of 13%, this amount of risk, and an average growth in the economy of just shy of 1% a year. If you then take the other half, the low growth countries, well, they actually over that same period of time had an average decline in economic activity. So I mean, that's about as slow growth as you can get, negative growth. But the average return to their markets was 13.5%, at about the same degree of volatility as the high growth countries. So you could take away two things from this. One, being invested in a low growth country is not a guarantee of a low return to your portfolio. And in fact, the second thing you might conclude from this is that you actually, you know, this 0.6% is not a small difference. 0.6% in a portfolio over 10 or 15 or 20 years will have a huge impact on the outcome. You might even say that you get a better return from low growth countries. Now, what's going on here? You know, this to some degree may seem irrational. Well, what's going on is that poor economic performance gets priced into the market. You know, investors observe all the things we're observing. They observe all of the negatives, all of the reasons why economy may grow slowly, and they price that into the stocks. They push the prices to the level where stocks are going to have an appropriately high return, taking into account the fact that the economy is in slow growth mode. So again, this is another example of wisdom of crowds. Markets are not blind. Markets are human beings, taking in all the information available to them and pricing assets accordingly so that they'll have an appropriate risk-adjusted return. So what do we do with this information? What are the implications? First of all, you need to have a plan. We know that while there may be regularities, the world and its various component parts are complex and chaotic. So you have to have a plan so you know what to do when it's hard to know what to do. Because we're all going to be prone to being hypnotized by the short term, whether the short term is today, this month, or this year. And it's going to tend to have a big impact on us. You know, the economy has been growing since June of last year, and the markets have been growing dramatically since March of last year, but we're all sort of still kind of, as I said earlier, walking around somewhat traumatized by what happened in late 2008, early 2009. And so we need to have a plan so that we know what to do when it's hard to know what to do. And we need to have a plan that builds resilience and flexibility into our financial life. Because the thing is this, you can plan around the regularities. You can build a plan based on the highest probability outcome, the regularities that tend to emerge from this complex, chaotic system that we call the economy, and this complex, chaotic system that we call the financial markets. You can build a plan that's founded on the regularities that we observe and that we believe will continue to observe, but you have to build flexibility and resilience in because of the short-term unknowns. So how do we do that? Well, first of all, having a plan. You need to think big picture. The plan needs to go beyond just looking at your investments. It needs to encompass all kinds of things. It needs to encompass having cash reserves, an emergency fund, right types and amounts of insurance, the right kinds of estate arrangements, looking at a safe withdrawal rate policy, which many of you have heard about before. If you're in the spending phase, you need to have a plan and some decision rules that will guide you, that will give you the flexibility to adapt to emerging realities year by year in your spending. And you need to have investment policies that give you some stability, but also have some ability to adapt to emerging realities. These things are about us not knowing the future. If you could perfectly predict the future, you would not have to have an emergency fund. Emergency, by definition, is something that emerges. Emergency is something that emerges. It's unpredictable. It emerges, it's there, you didn't anticipate it, but by God, you have some liquid reserves, you can deal with that emergency. Likewise with insurance. If you could perfectly predict the future, you really wouldn't need insurance. Insurance only makes sense because we can't predict what's going to happen next. And one might say it's the need for risk management in general is based on this notion that more things can happen than will happen. And of the many things that can happen, we don't know the one that will happen. And some of the ones that will happen are bad or involve financial loss of some sort. And so we have to have insurance. If we could perfectly predict the future, we'd avoid those risks that are going to lead to loss, and we wouldn't need insurance. But in the absence of a crystal ball, we need emergency reserves, we need insurance, we need to set up our estate arrangements in ways that account for the unknowns, that have lots of different options. Likewise, safe withdrawal rate policies and investment policies. This notion of safe withdrawal policies is that we want to have some stability in our spending, but we know that the world is going to change in ways we can't predict. We can't predict when we're going to have a down year in the markets, or when the economy is going to decline. And so we need to have some decision rules that can keep us on a sustainable path even in the midst of good and bad things happening. These guardrails that those of you I've talked to about safe withdrawal rates, these guardrails involve keeping you on a sustainable path when bad things happen, that's the capital preservation rule, and when good things happen, that's the prosperity rule. Sound investment process, one that takes into account both the knowns and the unknowns, both the regularities and the degree to which the regularities can be thrown out the window in the short run. And so you need to, first of all, identify those places where the markets seem to consistently provide an attractive return for risks taken. One of the things that as we talked about earlier, we can identify those regularities. We've seen them. Those regularities include the fact that small company stocks get priced for higher returns than large company stocks in the long run. Value stocks get priced for higher returns than growth stocks. Stocks get priced for higher returns than T-bills, and so forth. Explore the covariance matrix. That just means looking at how well these things play together. How well do they play together? I talked about the fact that in the late 90s, domestic and foreign small company stocks didn't look very attractive. They weren't doing nearly as well as the blue chips, as the S&P 500. And don't even get me started on the dot-coms. But come 2000 and 2001, they stepped into the breach. They were the heroes. They stepped up and they saved portfolios that were otherwise crumbling because they had tech stocks or blue chip stocks in them. That's what I call playing well together. Playing well together is when one asset class can step up and perform when another asset class is in decline. So you don't want them all doing the same thing at the same time. Efficient building blocks. Costs matter, expenses matter. You need to find ways to assemble a portfolio that isn't going to drain away all of your profits into the fees that go into exotic investments. Implementation, obviously once you've made all these decisions, you have to have a disciplined way in which you put them into practice, and then you have to be prepared to monitor, rebalance, and report. Rebalancing is that process where as things get out of balance, you restore the balance. You've decided the proportions you want to have in your portfolio, and then the markets will speak to you. I was talking about looking for ways to capture the wisdom of crowds, capture the wisdom that the market is sharing with you, this sort of aggregate wisdom that emerges in the markets. And the way that happens with rebalancing is that the markets will tell us when something's gotten expensive, because we have a target for how much of our portfolio is going to be in domestic small value stocks, for example. And at some point, they are going to grow relative to the rest of the portfolio and exceed their targets. Well, at that point, the market is telling us that this asset class is becoming relatively expensive compared to the other building blocks in our portfolio. And so we rebalance. We shave it back, and we reallocate some of those funds to the asset class that's falling below its target. Now, that's a process of selling high and buying low if you think of it in the abstract. But if you think of it in practical terms, it's a real discipline because you're selling some of the thing that's been making you happy recently, and you're buying some of the thing that's been making you sad recently. So it's a very disciplined, or a lot of discipline is required for that. And you have to be disciplined about simply repeating the process, constantly cycling through, revisiting your assumptions, adjusting your building blocks, always looking for more efficient ways to assemble a portfolio, and always looking for more effective techniques for monitoring and rebalancing and harvesting losses where appropriate and all the rest. So building flexibility, first of all, you want to have efficient building blocks. We happen to think that low-cost, no-load, institutional class fund portfolios are the most effective way to go. A couple of reasons for that. First of all, low-cost, no-load, that probably goes without saying. You need efficiency. You don't want to have a lot of your returns being sucked away in the form of excessive expenses. You don't want all those frictional expenses, you might say, to be sucking away your profits. But the other thing is that, you know, I've been talking about those regularities around small company stocks and value stocks and the reasons that the markets price those for higher returns. But it's important to remember one word, risk. You know, I've been saying that small company stocks have a unique risk associated with them, and therefore they get priced for, the markets price them for that unique risk, price them for an extra increment of return. Likewise, value stocks. Well, if they're getting priced for a higher return because they have some additional or unique risk, you need to diversify. You can't buy 5 small company stocks and be sufficiently diversified. You have to buy 500 or 5,000. You can't buy 5 value stocks and be adequately diversified. You have to buy 500 or 5,000. And the only way to efficiently do this at scale is with institutional class fund portfolios, whether it's from dimensional fund advisors or Vanguard Admiral class shares or exchange traded funds. You know, with some of these building blocks that we use, for example, the internal expenses for assembling and maintaining that portfolio can be as little as 0.07%. 0.07%. I mean, that's my way of looking at it, that's almost free, because, you know, no individual, even the wealthiest, could typically expect to assemble a portfolio at that scale and with that much efficiency. But collectively, we can do it if we turn to the right purveyors. Inefficient building blocks that you want to avoid are things like, you know, a REIT, by the way, is a real estate investment trust. It's a company that owns real estate assets. You know, there are REITs that trade on the stock exchange, and there are some that don't. Non-trading REITs, real estate partnerships, you know, these are things that it's easy to get into and damn hard to get out of. This is the antithesis of having flexibility in your portfolios. You want to have assets that give you access or give you exposure to efficient, attractive markets, but do so in a way that gives you flexibility, that allows you to, if circumstances change, allows you to convert them into cash in a day or two. You know, there's this notion of marketability. There's liquidity and marketability. Liquidity is a measure of how much something is like cash. So a money market fund is very much like cash. A checking account is very much like cash. You can turn it, assuming you have money in your account, you can turn a check into cash in a moment. So it's very liquid. These fund portfolios I'm talking about, they're not liquid because they're not like cash, but they're marketable. You can turn them into cash quickly. You just don't know at what price. But marketability is key. So as circumstances change, you can trade out of something and rebalance. You can't rebalance something that doesn't trade. You can't rebalance a non-trading REIT or a real estate partnership. You can't rebalance around that. But you can rebalance around these institutional fund portfolios because you can sell, and you can sell in any increments you want, large or small. Hedge funds are something that, you know, for a while was a status symbol, but really I don't think makes sense for most people. We don't think makes sense for most people. They tend to be opaque. That was part of what made them a status symbol. They were hard to get into, and nobody knew what was going on in there. And for a while, it looked like what was going on inside the hedge funds was magic. And then the magic turned to horror. But very often with hedge funds, there was only once a year, if that you had the option of getting in or out. So again, you had no ability to adapt your portfolio of assets to your emerging needs in your life. Absolute return funds, again, something that makes no sense at all. It's sort of an empty promise that, oh, we're going to target an absolute return of whatever, 6%, 7%, 10%, as if promising something is the same as achieving it. Commodities, future strategies, again, you're just gambling in many of these cases. So here are the key concepts I want to leave you with. The economy and the financial markets, they are too complex and chaotic for reliable prediction. So any strategy that's predicated on you or anyone else being able to predict what's going to happen tomorrow or next month or next year is guaranteed to fail. It's guaranteed to fail. If not this year, next or the year after. I mean, people guessing can sometimes guess right. Just like someone going to Las Vegas can sometimes come away a big winner. But if you go back to Las Vegas often enough, you will lose. So if we accept the fact that the economy and the financial markets are too complex and chaotic for reliable prediction, what do we do next? Well, we look at what those regularities that emerge from the chaos. There are regularities. And we try and incorporate those regularities into our plans. And we think big picture when we're planning for the future. We think big picture in terms of building flexibility into our arrangements. We don't try and bet on a single outcome. So that is the conclusion of our webinar. I didn't even start out mentioning it, but obviously Groundhog Day is a reference to the Bill Murray film, I should say, the Bill Murray film, in which he woke up every morning and he was reliving the same day again and again and again. And we want to suggest that, the world we live in has some regularities, maybe not quite as regular as that, but as Mark Twain said, while history may not repeat, it sure does rhyme. And that was a great insight. So thank you very much for being with us. We will have a recorded version of this available soon on our website, and we'll give you a heads up so that you can listen to it again if you care to, or can share it with friends or family. And so thank you, and I look forward to seeing you again sometime soon.